Aloha, and welcome to the Sylvan Bell Business Growth and Exit Strategy Podcast, your guide to building companies that command maximum multiples. I'm Sylvan Bell, author of 5 books on business strategy and sales, creator of the Sell Framework, Scale Framework, and Driver Test. I work with owners of $10 million to $250 million companies, whether you're scaling for growth or positioning for a profitable exit. Each episode breaks down one framework, strategy, or concept you can apply this week to grow revenue systematically, scale operations, and maximize enterprise value. Let's get started. Today, we are on episode number 11, Why Profit Alone Does Not Equal Business Value. What you need to know is you could be highly profitable and still be worth less than what you think. Buyers don't purchase profit, they buy reliable profit. They're looking for consistency. The word of the day is consistency. When you talk to business owners, when you talk to operators, one of the things practitioners, they like to say is, hey, we're going to celebrate our profit. Buyers, investors ask how repeatable and how transferable is it? Transferability. Can we make the magic happen again? And if the earnings are fragile, the multiple starts taking dings and dents, even if the profit and the loss looks great. Profit is a lagging indicator. It reflects decisions you've already made, not what a buyer can count on moving into the forward. Buyers pay for what they believe will persist after ownership changes. What's the probability? Okay, so if we're going to be a scientist about this, we're going to ask probability questions. What's the probability of your team, your product, your service doing the same thing again with an increase next year? And if the answer is, I don't know, then that illuminates some of the concerns, some of the problems, some of the issues for you. If you say, hey, Scott, I could leave for 3 months and next year the company will grow by the standard 8, 10, 15, 20, 30%. We're going to hit our benchmarks. That puts you in a really good position. In fact, you should prepare for that conversation. When you go to sell a business, you're going to sit down with a team, or they're going to send you a document with about 300, 400 questions in it. And then sometimes they interview you afterwards. And one of the things that you should be able to prepare to say is, hey, at any given time, I could take 3 months off and the company's going to run without me. Unsustainable profits and sources, they get discounted. They're looked at like a ding or a dent inside of the valuation. Something like it's just a one-time win. It was a one-time big contract. Temporary discounts from the vendor, or temporary terms from the vendor, one-off price spike, looks profitable, but they signal noise, and buyers will tell and test from looking at the margins and revert back to the mean. I always like to say this. There's somebody who's 23, 24, 25, super smart MBA grad that is sitting in a cubicle and their only job is to look at Excel files, and they are exceptional at it. They are phenomenal at it. And they can sniff things out. They're looking for variance. They're looking for risk. And what they're going to do is they're going to convey it to the team. So due diligence, when the company goes to be sold, is usually done by a team. There is an accountant, there is an actuary, or a statistician, so to speak, that goes through the files, and then they assign a value to the risk. So they go, here is what was profit, here is the multiple, whether it's seller's discretionary earning, or whether it's EBITDA, and they say, or whether it's times revenue, multiple times revenue. Those are the 3 ways that a business is valued. And they assign a value to it. And they say, this is how I got here. Very rigid, very to the point, very exact. And having a conversation, this is what they're all about. This is what they went to school for. This is what they want to do. This is what they talk about on the weekends. When you take a look at one-time margin distortions, they create false confidence. You can look at the books and like, oh, we had a really great quarter. Is it duplicatable? Can we get consistency? Can we do it again? A single really good quarter can be a trap, especially if it's driven by timing, deferred expenses, favorable terms. You just got to know that they are looking, they're smart enough. They've had the excuses, they've had the stories, they've had the playbooks before. When you look inside of the company, if the profit exists because you, as the owner, the founder, the rainmaker, the fixer, the closer, the buyer sees key person risk. And that turns into earnouts, that turns into holdback, that turns into lower multiples. At the end of the day, it's just less money for you. Sometimes people will say, well, let's turn to cost cutting. And yes, that can increase profitability, but it can also shrink value. Cutting training, cutting maintenance, cutting marketing, cutting key hires. It'll show up short term for profit, but it increases your operational risk. It causes questions to say, hey, what happens if? What happens if? And one of the greatest strategies or the tools that you could use is have red team exercises inside of your management meetings. What if we change this feature? What if we take this away? What if we do a reduction in force? What's it going to cause? What's the harm that it's going to cause? And then you can take that information and work with confidants, work with a consultant and say, hey, if I do these things, what kind of risk do you think it's going to put my company under? What kind of reduction in value do you think that I might get? There are computer models that rebuild your earnings. They adjust for owner compensation, personal expenses, non-reoccurring items, performer claims, things they don't trust. Your stated profit and your profit and loss is just the beginning. They're going to go through the books. They're going to take a look. They're going to dig in deep. And you might as well have everything ready to get the maximum multiple. You want the maximum multiple. That's what everybody wants. What you don't want is their adjusted profit. You want to be able to argue for it. It's a negotiation. Just so you know, when a company is getting sold, there are elements of a negotiation. And what you can do is if you have proof, if you have history, you can go to that proof, you can go to that history and say, hey, look, I have 3 years of running information that says that that's wrong. Let's have this conversation. It might delay the sale. Most sales happen in 90 days. It might take you 120. I've seen deals take 2 years. If you're in it for the long run, if you're in it for the maximum multiple, it's not going to hurt you to wait 30 days. Unless there's a tax horizon event, then that's a different story. And message from your sponsor, Scott Sylvan Bell. That's me. If you're getting value from this episode, here's how to go deeper. First, subscribe to my weekly newsletter, The Party, at scottsylvanbell.com. That's where I share the strategies, frameworks, and case studies I don't release anywhere else. You'll get one actionable insight every week you can implement inside your business immediately. Second, while you're on the site, download the complete Sell Framework, Scale Framework, and Driver's Test, all free with scoring guides, worksheets, and step-by-step implementation checklist. These are the same frameworks I use with $10 million to $250 million companies to build systematic revenue, scale operations, and maximize enterprise value. Go to scottsylvanbell.com right now, subscribe to the newsletter, grab the frameworks, and let's keep building companies that command maximum multiples. Let's get going. When you talk to investors, they have a phrase. It's quality of earnings, Q of E, and that's better than quantity of earnings. Buyers want earnings that are clean, reoccurring, and supported by strong controls. You can find in a purchase that lower profit with higher reliability can be worth more than higher profit with volatility. You want to be able to prove repeatability. You want to be able to show quality of what you're doing. And profit without systems doesn't transfer. You have to have the systems. You can't have a company that runs on heroics, memory, informal execution, because profits are seen as accidental. Systems inside of your organization turn profits into something a new owner can operate. Not just go here and, hey, we got this shiny new thing. I like to give the analogy that if you're selling a car, you want to be able to turn the keys over, the title over, and walk away and say, enjoy your car. What you don't want is a whole bunch of phone calls saying, hey, this broke on me. Hey, do you know why this isn't working? Systems inside of an operation stop that from happening. Profit fragility shows up in concentration and dependency. If it's too few of clients, one channel for being sold, one product, one person drives all the decisions or the bulk of profit, the buyer sees a problem. They see more risk and they put all that risk on you. It might be a lower multiple. It might be an earnout. It might be a holdback. It might be a clawback if it comes back to them saying, hey, this wasn't done. When you take a look inside of an organization, any margin or any line of business that requires special knowledge and it only depends upon special knowledge are a red flag, because you don't know how pricing is set. You don't know how delivery is going to be. You don't know how problems are going to be solved. And profit becomes personality based. What happens if that person leaves? What happens if they get hurt? What happens if they just decide to move? Investors pay less for profits that can't be taught or documented. Everything should be taught or documented. One of the things that you'll find is black boxing. And black boxing information is this. You have an employee inside of a position that loves to have control but doesn't want to tell you what's going on. And what they'll do is they'll gum up the works. They will hold back every piece of information that they can from you. All for control, and all because they want things to be done their way. It could be that they're a control freak. It could be that they're not good at delegation. But you have to be aware of spotting on your team who's black boxing information. You're paying them. They've got to give you the information back. And so there's ways to gather this intel. One, you could do side-by-sides where somebody sits next to them. Two, you can have them record what they do on something like Loom, as we're recording this session today, or screen capture. And if they're in a position where it's out in the field, it's a ride-along. What you're going to find is at some point, you're going to have a decision with somebody who black boxes information. Either they're going to play ball, which is very rare, just so you know. You're going to pay them to stay home, or you're going to ask them to leave. If you're looking for the maximum multiple, the people who are blocking you from understanding the roles and responsibilities inside of an organization, they're taking money out of your retirement. They're taking money out of your exit. And you have to look at it like, well, you don't have to. You can choose not to, but you should. You should look at it that way. Predictability is what turns profit into a premium multiple. If your industry pays out a 3x multiple, you should really be shooting for a 4 or 5, and it's entirely possible with the right amount of work previous to selling the company. If you can forecast and hit targets consistently, right? The key is consistently. There's less protective terms. That confidence supports a better price, a better payout for you for that maximum multiple. Cleaner structure, faster closes. These are all the things that you want. You want value beyond the profit and loss statement. Buyers are willing to underwrite more if you can prove these things. Leadership depth, client stick. How long does a client stick around? Process maturity, reporting cadence, and governance that reduces risk. These are what support a higher multiple, the maximum multiple for you. So we're going to play a game. What happens if you step away for 60 days? Would profit hold? Not just can the team take care of things, are we going to be profitable? Pick one of the fragility drivers this quarter: dependency, concentration, lack of documentation, and map it out. And I will say this, one last thing before we close. Sometimes you have to hire fractional people to come in and help. And what's going to happen is you're going to have an employee, you're going to have a department that doesn't want to move forward. And what you may have to do is you may have to bring somebody in and capture that field and say, here, I brought people in, we're going to make this work. You're going to show them how we do this, or we're going to get you caught up. Accounting in almost every company is something that runs behind. In almost every company. I have this belief that accounting should be closed out on the 8th, 9th, or 10th of every month. So if your month is over, if January is over, February 8th, 9th, or 10th, books are supposed to be closed out. If it's February and you're going into March 8th, 9th, or 10th, books should be closed out to a large extent. And if you have to hire a fractional accountant to come in to help get everything put into the ledger, what you're going to find is you're able to start taking away excuses. You're able to see inefficiencies inside of departments. And that's really what you're looking for. Like, where are the departments inefficient? Where are they deficient? And what do we got to do to solve this problem? I just want to let you know that I appreciate you for checking out this episode of the Business Growth and Exit Strategy podcast. Would love for you to share this with a friend. We'll see you on the next episode. Aloha and mahalo. We're on. Mahalo for listening to the Sylvan Bell Business Growth and Exit Strategy podcast. Here's what's available to you right now. First, subscribe to this podcast so you get every framework we release. Second, visit scottsylvanbell.com to access the Sell Framework, Scale Framework, and Driver Test. All free with complete scoring guides and implementation worksheets. Third, subscribe to my weekly newsletter, The Party, where I break down strategies and frameworks you won't find anywhere else with one actionable insight every week. Go to scottsylvanbell.com and enter your email. And if this episode added value, share it with another business owner building a $10 million to $250 million company. Until next time, Keep building companies that command maximum multiples. Aloha.